The U.S. stock market indices have been on the longest winning streak since the fall of 2021. The key question in investors' minds now is if the market trend has completely reversed itself from the bear grip and embraced the bull run, or if the bear is still flirting with stocks, giving them a nudge to enjoy the last rallies before punching them to the ground. Investment director of asset management company Sigma Global Management, Vladislav Petlenko, shares his perspective on the current U.S. stock market situation. Hello, Vladislav. What do you think is happening in the market? Is it a bull market or a bear rally?
Hello, thank you. It's an excellent question. At present, both arguments hold merit. It's uncertain whether the consecutive weeks of gains will lead to a bull market or a bear rally that may go down again. Several substantial market factors can prompt either one of the trends to get the upper hand.
Can you expand more on what driving forces make a case for a bull market?
Sure, I'll try. Let me give you, for example, 4 reasons for a bull market. Firstly, the fear index is too low. I remind you, it measures the cost of options tied to S&P, and we expected it to be high in the turbulent times, but it's not. Secondly, a 20% surge from the recent lows signals a shift from a bear market to a bull market. Furthermore, the long positions in S&P futures outnumbered the short positions by maybe 9-1, which suggests investors are confident about future growth. And moreover, the Russell 2000 index has jumped 7-8% in June alone, and we expect a continued positive trend.
Interesting. But it seems as if the rally has not lasted all that long. It has not even been a year. How can you comment on that?
Yeah, indeed. The recovery has lasted too long to call it a bear market. Maybe too long. It had been nearly 250 days since the October of 2022, when the S&P hit the most recent low. If I remember correctly, it was about 3,500. It's unusual for a bear rally to last that long. Lastly, the job market is still growing, the inflation rate has slowed down, and the Federal Reserve has taken a break from raising interest rates.
Thanks for explaining that. Now let us talk about the case for a bear market. What is your take on it?
Firstly, it's essential to note that the market breadth is very narrow. The tech sector has been the key reason for the market's upward trend. Only a few large tech companies such as Apple, Microsoft, and Alphabet, and others have led the surge. Nearly half of the stocks in the S&P have dropped so far in 2023. Even in 2000, the weighting of the top 10 in the broad market indices was much lighter than 25-6% today. There are concerns that this trend may not be sustainable.
A great explanation, thank you. However, some experts argue that the bull market will not start until the index exceeds its prior high of January 2022. What is your take on it?
Yeah, it's a valid argument. With time, things may still change. For example, during the bear market of 2000, caused by .com crash, the Nasdaq entered 8 bear market rallies for at least maybe 15-18%, all of which proven temporary. It may be a bull run in a bear market scenario now. So, investors need to keep in mind both cases before making a move.
Thank you for your detailed explanation of both sides. What should investors do in such uncertain times?
It's always, let me say, a challenging call to make, even for professionals and institutions. However, investors should be cautious and diversify their portfolios, of course. They need to monitor the market trends and be patient. Investors with a long-term mindset should not worry much about short-term market fluctuations. For example, we at Sigma Global Management utilize a long-short volatility-based portfolio management strategy, which is long-term and designed to minimize market risk by making, let's say, for example, 50% of portfolio allocation in long and 50% in short position in terms of market exposition. And in this long-short portfolio strategy, the risk of losses and market exposition are minimized by buying undervalued stocks and selling overvalued stocks. So the gist is that if the market declines and the long position take losses, the short positions will provide gains and minimize overall losses and keep the portfolio profitable, and vice versa.
You mentioned that the recovery has lasted too long to call it a bear market. Does that mean that the bear market is out of the equation now?
Not really. A bear market could still turn the tables given the current scenario. Inflation and higher interest rates have already deaccelerated global economic growth, which may further weigh on demand across industries. It's essential to keep an eye on the market trends and the internal and external factors that influence the market. Also, while both bull and bear market have their particular traits, still, historically, every bull and bear market has not been the same as the previous one. To be back to what I said, for example, the bear market that set off in 2000 and extended in 2002 was triggered by the so-called bursting of the tech bubble. In 2001, it became worse as the result of the tragic event of 9/11 and its impact on the economy. However, even during that bear market, a few sectors of the economy still did well for investors through the whole bear market. For example, real estate performed very well during the tech bear market, returning like about 20% and never going negative, what the most important.
Thank you for summarizing the main points, Vladislav. It was great to have you here.
Thank you. Thank you for having me for this short conversation. And it was, of course, a pleasure to share my insights.